Okay, gang, so I hope to make this a really quick video. It's not going to take us but just a minute to get our values for our end of year one balance sheet. As you noticed in the end of that long video yesterday, the balance sheet is going to balance. Your total assets will equal your total liabilities plus equities. So essentially what we need to do is we simply need to copy our formatting. That's to say we'll copy our cell formatting and our formulas over to the next column. Okay, so I'm just going to hit copy here. I'm going to right click and hit copy. And then on end of year one, I'm going to do paste special. And I want to copy my formulas and my formats over to my end of year one column. Okay, so when I do that, I get some gobbledygook numbers in there. And don't worry about that, okay? We'll fix those gobbledygook numbers because what's happening is it's looking, and when you copy the formula over, it's looking to the cells that are 3 cells to the right of wherever this comes from. So as you see, cash flow G11, that's going to be looking at cash flow D11. So it's looking specifically on the cash flow 3 cells to the right, since this is 3 cells to the right. And don't worry about that, okay? We just want the formulas and the formatting to be copied over. So for our end of one cash, we'll put a formula in, say go to the cash flow and pick up my end of year one cash. Okay, that's $304,005 in my case. My inventory remains unchanged, and the reason for that is my beginning inventory is $312,000. Every time that I sell something, my cost of goods sold replaces whatever I sold. Okay, so if I go back to my inventory here, it's going to be exactly the same as it was at the beginning. But the best practice here is actually to go to your cash flow and pick up your beginning inventory value from your total column. In case you happen to add any additional inventory during the process, say you added, doubled your inventory in July, it would pick up that as inventory, okay? So at any rate, that's what we do. Our delivery vehicle is going to be exactly the same methodology. We'll go to our cash flow, pick up our delivery vehicle as of the end of the year, and then our furniture, fixtures, and equipment, we're going to do the same thing. Go to our cash flow for the end of the year, pick up furniture, fixtures, and equipment. Okay, for accumulated depreciation on the delivery vehicle, we can find that value very easily on our income statement, because remember, when we copied that information over to the income statement, we put in a formula that said take what's on the cash flow and divide it for our delivery vehicle by 7, because that was our depreciation period. And then for our furniture, fixtures, and equipment, we said take that value that's on the cash flow and we'll divide it by 5. Okay, so if you'll recall, we spent $35,000 on the vehicle. Depreciation straight line over 7 years, is $5,000 per year. On the furniture, fixtures, and equipment, we have $15,000. Depreciation over 5 years is $3,000 per year. Okay, so remember, our formula is plus the asset minus the depreciation plus the asset minus the depreciation gives us our net fixed assets. Our security deposit is going to be the same as finding out our inventory balance and so on. Okay, so from our balance sheet, we'll put in a formula that says for security deposits, go over here to our cash flow and pick up the value at the end. It's $20,536. For our prepaid expenses, we don't have any at the end of the year. In other words, what does that mean? All of these expenses that were recorded here pre-startup, and that's property insurance, workers' compensation insurance, and advertising, all of those values were accounted for and used as expenses on our year one income statement. Therefore, at the end of year one, we have no prepaid expenses. Our value there is 0. Okay, so we'll simply type a 0 in. For our long-term liabilities, this takes a little bit of thinking it through. Okay, we've got our loan amortization table in there. So really when we talk about the net current portion of our long-term debt, we're talking about the principal portion that gets paid in the next 12 months, right? Well, at the end of the year, we're actually looking for the principal that's paid in year 2. Another way of looking at that would be the principal that's paid in months 13 through 24. We have that information here on the loan amortization. If we look at our principal for months 13 through 24, okay, months 13 through 24, I'm just highlighting those cells to show you the months that we're specifically talking about. The sum of those is shown here. It's $70,390.50. The easiest way to do this, y'all, just quite frankly, is to put in $70,391. Obviously, $70,390.50 is going to round up, so we'll say $70,391. Okay. Now, our note payable at the end of the year is going to be the same amount as this net long-term liabilities here. Okay, so all we have to do to get that number over here is just put in a formula that says go there. Okay, and that tells us, of course, at the end of year 2, our net long-term liability is going to be 238, and so on and so forth. Okay, you'll notice that this 308,699 matches this, so the same number appears a couple of different places. Okay, when you've done it right, you can look at your loan amortization table, and it'll give you an ending balance after that payment is made. See, 238,308.31. If we go back to the balance sheet, 238,308. If you go back to the loan amortization again, after the month's 12 payment is made, you see it's 308,699. Looking at the balance sheet, 308,699. So it's not magic, it's just the way that we're treating that, and we're breaking out the portion of the principal that's payable in the next 12 months. Obviously, at the end of year 1, the net current portion is going to be the principal for all of year 2. Since we don't have a cash flow statement for year 2 like we do for year 1, right? This is year 1 cash flow. We have to go back to our loan amortization table to pick up those values. Okay, hope that makes sense. If it doesn't, just get with me and I'll explain it a little better for you. Our owner's investment is unchanged, but again, best practices say just in case we put in some more owner's investment during the course of the year, we need to go here to the total column and pick that up. Okay, our earnings very easily comes from our income statement. All we have to do is put in a formula that says go to my income statement and pick up my net profit. Okay, and then for our owner's draws, all we have to do to pick up our owner's draws is go to our cash flow statement and look at the amount of money that we withdrew from the business. In this case, we'll go to the totals column. It's obviously $30,000. When we copy that number over, okay, we say cash flow Q29. When we copy that over, look, our balance sheet balances. Okay, if you've done your formulas correctly and you've gone to the right place and gotten the numbers and copied that over as you should, there is no reason whatsoever why your end of year balance sheet shouldn't balance to the penny. Okay, as you can see clearly here, mine does. So that's the balance sheet in a nutshell, and I hope that at this point, you know, it's kind of like a light bulb coming on. You're beginning to see, okay, so that's how that works. So at any rate, hope this helps, and I'll look forward to reviewing your information after you turn it in on Sunday night. Thanks so much.